Okay, we're going to do a practice statement of adjustments, and we have a scenario here. We've got a closing December 21st, 2013. I picked 2013 because it is not a leap year. 2012 is a leap year and has 366 days. So you're normally dividing, when you're working out your daily amounts, by the number of days in the year, 365. But if you're working with a leap year, you're dividing by 366. Why are we doing the statement of adjustments? Well, we've got to come up with the balance due on closing. Under Form 100, the agreement of purchase and sale. There was an agreed purchase price, but the contract says that it's subject to adjustments for rent, fuel, oil, and taxes, and that's what we're going to do here. And this scenario has a rental unit, so not all situations will have a rental unit. Our clients have put down a deposit of $30,000 a year. Do we have to adjust for this? Yes, of course, because it's been paid into the real estate account for the vendor usually. And so we don't want them to have to pay the deposit again, so obviously they don't have to come up with the $30,000. And when we work out the balance due on closing, it's going to be $488,900 minus that $30,000. But we've got to adjust for other things like the taxes. So the taxes in this case are $47.56 per year. And as a diligent solicitor's office for the purchaser, we write to the city to find out and get a tax certificate, and they tell us that we're at the end of the year. They've paid up until January 1st for all of the taxes in this scenario. So they have paid the entire taxes, but we've got to adjust for the amount that the vendor has overpaid the taxes, because the vendor shouldn't be paying the taxes for the purchaser. So if you're buying a house that's closing, let's say June the 30th, and the homeowner happens to have paid the entire year's taxes, why would they pay until the end of the year? So you're always adjusting for the taxes, and you're having to work out the taxes on a per diem basis to take the total amount and divide by 365, and that tells you how many days per year. The vendor's share of taxes is up until the day before closing, because the contract says that the purchaser is responsible for the day of closing. We're also going to be adjusting for the oil tank. And why is there an oil tank in this scenario? Most houses don't have them, but on test situations, they usually have them. For the basement apartment, the landlord's holding on to that security deposit we found out. So we've got to adjust for that. They're not going to hand over the security deposit separately, that last month's rent. What we're going to do is we're going to adjust for that. But we also got to adjust for the fact that the tenant has paid rent at the beginning of the month in advance, and we confirm that with the other side. And we've got to work that out on a per diem basis as well. Normally, you'd have to calculate and adjust for the interest on the last month's rent, the $970. This used to be pretty simple, that it was 5% under the law that the landlord had to pay, and he'd work that out. But the tenant guidelines fluctuate from year to year based on the consumer price index. So I've left this out just to keep the exercise a little bit simpler. We're not going to work out that actual interest. So here's our statement of adjustments template. You can set this up as a chart using Microsoft Word. You can also use Microsoft Excel. You can make the lines disappear at the end if you're familiar with how to use the software on Excel. And you've got to line up your columns, and you've got to do it to the last penny, and we're going to be doing some rounding off. So we've got set up at the top the vendors and the purchasers, their names and address, adjusted as of December 21st, 2013. That's our closing date. And we've got a column for the amount, the different adjustments, and credits to the purchasers and credits to the vendor. So the sale price here is $488,900. So we put that down in the right-hand side as a credit to the vendors. The deposit comes on the left-hand side always, and it's a credit to the purchasers. Why? Because the purchasers have already paid it. They don't have to pay it again. and so we're having to adjust for that. So now we're going to work on the realty taxes, and the realty taxes for the current year are 4756.00. So I've entered in the amount current year 4756, and we've got to work out the per diem. So we take, I've got a big calculator here that I use, and hopefully you can see this. 4756 divided by 365 equals your per diem. You don't want to round this off too soon, so I suggest that you do it to 4 decimal places, which is $13.03.01. You don't have to round from the 3 if you're doing it to 4 decimal places. So I've entered in the amount of the per diem. That should be 13.03, not a comma. And I've got to work this $13 and so many cents per day into how much the vendor's share is for December 20th. Why December 20th? Because the vendor's share of taxes, according to Form 100, is up until the day before closing. So you've always got to remember, look at the closing date, December 21st here, and we're adjusting it to December, the taxes for to December 20th is the vendor's share of taxes. So we take 13.0301, we multiply it by 354 because we've worked out what day is December 20th, and you can use the poem or you can use the knuckle calendar that we've talked about, and you can add up the 31 days in January, 28 days February, 31 in March. You can add those all up and add for 20 days for December, and you come up with number 354 days. It's the 354th day of the year. If you have a desk calendar that tells you that, or if you use the internet, you can find out what day that is. So we multiply 3.0301 times 354, and that gives us $4,612.66. So I put in the number here, 4612.66. We know that the vendors have paid the entire amount of taxes, which is 4756. And so to figure out what the vendors are credited to, because they've overpaid the taxes, we just subtract. So we take 4756 minus 4612.66, and that gives us $143.34.